Oil is at $90 a barrel. A few weeks ago, it was around 55, 60. And right now, thousands of investors are staring at their portfolios, watching their positions bleed. They are absolutely panicking. Today, I want to talk about why that panic is probably the most dangerous thing in your portfolio right now. Not the war, not the oil price, the panic. If you're sitting on positions that are underwater, maybe Tesla, Nvidia, maybe one of the other massive names, and you don't know whether to hold, sell, or run for the hills, then maybe this video is for you. We're going to go through 4 real scenarios of just how this could play out, and I'm going to tell you honestly what each one means for your money. No waffle. So let's just get into it. First, I want to be clear about something. I'm not trading oil, I don't trade commodities. I'm a stock trader, a swing trader, trading the trend. But I watch oil most days, especially at the moment, because it's one of the best macro signals we've got right now. It tells you what the market is feeling. And here's how it works. When oil goes up sharply, that means war fear is high. Inflation concerns are rising. The Fed is getting nervous about cutting rates. Borrowing costs are staying high. Growth stocks are suffering, such as the Mag 7. Money rotates into safe havens such as healthcare or consumer staples. And when oil drops sharply, fear eases. Everyone's happy. Inflation pressures come off. The Fed gets room to cut. Risk appetite comes back in. Money floods back into tech and growth, and it brushes aside all other bearish news. Oil is the mood ring of the entire market right now, and at $90 a barrel and the Strait of Hormuz closed, the market's mood is somewhere between nervous and absolutely bricking it. Right, let's talk about what might actually happen, because nobody seems to be laying this out clearly. Scenario 1, the war drags on, oil goes even higher. This is the slow bleed, not a crash, just a sustained, grinding pressure on everything that needs cheap money to survive. Before this conflict, markets were expecting the Fed to cut rates around July, September, but that's completely gone now. Multiple Fed officials have already said that inflation is too sticky to even think about cutting. If oil stays up here and it feeds into energy costs, transport costs and food costs, we're looking at inflation coming back aggressively. That's bad. And what does that mean for your portfolio? Well, growth stocks are going to stay under pressure. High multiple tech names are going to stay under pressure. Anyone waiting for a rate cut to rescue their positions are going to be waiting a very long time. And this is the cool part. Even the rotation trades that everyone's piling into right now, defense stock, gold, utilities, a lot of that move has already happened. You might be too late to get involved unless you can trade a decent pullback, but headline influencing pullbacks can be tough. Scenario 2, the war ends tomorrow. A peace deal overnight. The relief rally. It would be violent, instant. Oil would crater, probably back to around $65, $70. Fear premium gone overnight. Money floods back into risk assets, and the Mag 7 rips. Sounds brilliant, right? Well, yeah, in the short term, it probably is great if you're positioned correctly. When that headline drops, you need to be there to make money fast. But the market recovering and the economy recovering are two different things. The price can go up with just emotion alone, while the fundamentals don't really move. Think of it like this. If someone punches you in the face and then apologises, the apology doesn't unbreak your nose. The inflation data, the Fed's timeline and the borrowing costs, that's the broken nose. It heals on its own schedule and not yours. Scenario 3, peace comes, but the damage to the economy is already done. This is different to scenario 2. Scenario 2 was about what the markets would do in the short term. This is about what the economy has to deal with going forward, regardless of what happens in the next few weeks. As I said earlier, before this conflict, markets are expecting 2 or 3 rate cuts this year. That is out of the question. Goldman Sachs has flagged that if oil stays above $80, the Fed might not just delay cutting, they could hike. Even if oil falls back tomorrow, the inflation data has already been recorded. Those expectations are already in the system. The Fed has already seen it, and they move slowly, deliberately, on purpose. So even in the best case scenario, war ends, oil drops, markets rally, you could still be sitting on a higher for longer rate environment. The market might celebrate, but your mortgage rate won't. Your company's debt refinancing won't. The valuation model on high multiple tech stocks won't. That's the difference. Scenario 2 is what you'll feel when peace is announced. Scenario 3 is what you'll live with for the next maybe 12 months. Scenario 4, as we said earlier, will the crowd just ignore the fundamentals as peace comes? Short answer, yes, it will. Relief after fear is one of the most powerful forces in the market. People don't stop to analyse geopolitical nuance in the moment. They feel the weight has been lifted and they click in the buy button. FOMO kicks in, green candles appear, and everyone gets excited and everyone piles in. And look, that initial move might be the correct one. Markets do recover. History shows that clearly, but the crowd won't be asking, has the Fed's timeline actually changed? Is inflation back under control? They'll be feeling good and they'll again be clicking the buy button. The gap between how the crowd feels and what the fundamentals actually say, that's where good investors and traders make their money. So what are your options? Let me be direct with you now. A lot of people watching this are sitting on those names, those massive names, the Mag 7, and they look quite depressing, don't they? You bought somewhere near the top and you've watched them slide and you don't know what to do. I've been there. It's not a nice place to sit, but before you do anything, you need to decide what you are. If you're in this for the long haul, 10, 20 years or more, you just want to take a breath. Because history has something important to say to you. As an investor, imagine you started investing in the absolute worst possible moments in history. The peak of the Great Depression in 1929. Markets about to collapse. If you just left that money alone, by the time your kids were adults, you would have made money. Same story in 2000, same story in 2008. Every single person who held long enough came out of the other side in profit. Could this time be different? Who knows, but probabilities are on your side. If you wait until it feels safe to get back in, then history shows you'll probably buy back in after the best days have already happened. That's not me trying to scare you into holding. That's just what the numbers show. Every single time this has happened in history. Here at Obara, we are swing traders. We're not making 10-year bets. We are reading where money is flowing right now. And tactically, rotation into defensives makes sense. But if a ceasefire headline drops at around 2 a.m. and suddenly your defensive positions sell off hard while tech is gapping up without you, position sizing, stop losses and risk analysis should already be in place to protect you. Non-negotiable, especially in this environment. So what am I actually doing right now? Well, personally, I'm just watching the markets. Different companies in different sectors where the money is rotating, but I'm not going mental and buying everything. I'm analysing companies, I'm looking at the fundamentals, I'm looking what's brushing off this volatility. I'm looking for clean trends, but understanding that things could change quickly. I'm looking for sectors and crowds that are not losing their heads, a bit like software. I'm going to be going through some specific names in upcoming videos as the picture becomes clearer, because right now, with oil going mental and a conflict that could end tomorrow or maybe escalate further, anyone claiming to have any certainty about what's going to happen is having you on. Here's the thing I keep coming back to. Being a good investor or a trader isn't about being the smartest person in the room. It's about not being the most emotional person in the room. Right now, markets are driven by fear. And fear makes people do things that are illogical. Oil at $90 is a signal. Not a buy signal, not a sell signal. It's a read the room signal. So before you do anything next week, ask yourself this. Which scenario am I positioned for? And does my portfolio reflect my thesis? Or does it just reflect the last 2 weeks of headlines? That's a question I'm sitting with. If this video was useful to you, maybe give me a like and a subscribe, it'd be great. I am quite new to this and I think it's getting better, isn't it? I hope it's getting better. I'd love a bit of feedback. So I'll see you on the next one. Thanks.